Perfect. Welcome everybody to Wednesday Winners. This in-depth TLG training I do every Wednesday at 8 p.m. Zoom training. We do this, pretty much every Wednesday except for the last Wednesday of the month. We've been rolling for this for I think I've been doing this for almost a year now, where we just go over, more of the finesse stuff, more skills to widen your scope. And tonight we have one of my favorite products is the IUL. Everybody gets excited about the IUL because it has so much value to offer the clients, but it can get pretty tricky, and understanding it is pretty much the first step. So what I wanted to go over is we're going to kind of break down what an IUL is tonight. We're going to show you what it is, what it's used for, and then we're going to show you when to write it and how to write it. Those are the big areas that we're going to hit. We're going to hit the basics so that you can get an idea. Get with your growing upline if you have more questions. Of course, as always, we'll have a Q&A at the end. We might run a little bit long tonight because there's a lot of information with IULs, a lot of different techniques. Hey guys, can we mute your lines? Looks like Deborah and Suzanne. That'd be great. Thank you. Once we're done that, like I said, we'll do a Q&A and see where you guys are at from there. But if you have any specific questions, reach out to your growing upline. So IUL, what is it? We hear about it all the time. You see a lot of big AP with people writing IULs, 5, 6, 7, 8, 10,000 annual premium. Peter Meyer did a lot of IULs for his month where he wrote over 86,000 annual premium, and that was the capped amount. So an IUL is a type of permanent life insurance, okay? Just like whole life. There are some key differences. A whole life policy is a policy that's focused on the death benefit. You have a level death benefit for the entire time, usually until your age 120. That's life, right? Or 121. Some carriers do it different, but that's your entire life. It's permanent life insurance. It also has a option where you're going to earn cash value. Now, where does this cash come from? Well, in a whole life policy, it's going to take your premiums and put them into an account that is attached to the stock market, but it's not actually in the stock market. So it's going to earn a fixed rate, usually with whole life, okay? Traditional whole life. It's going to earn a fixed rate. An IUL is going to earn a range of rates. It's going to have a floor rate, so it cannot earn below that percentage, and it's going to have a cap rate, which it means it cannot go above that percentage. In a whole life scenario, you're really focused on the death benefit, right? They want the death benefit for their entire life. That's the main focus. The bonus, the value, is that you get to earn some cash value. You can take loans out from it. You can withdraw it and surrender the policy if you were done with the policy and didn't feel like you need it. Another cool thing is that you can let the cash value that's built up to pay the premiums for a certain period of time, depending on what that looks like. And with whole life, you can sometimes get dividends, or you can send those dividends to pay down, what you owe on the policy, because there is a predetermined cost of insurance for your entire life. There's a couple of different ways in whole life that you can do that. You can either pay up in some carriers will have you pay up the whole policy in 10 years. Like Bright Future Children's Policy from Foresters is a whole life permanent policy that you can have paid up in 10 years. That means if they want $75,000 of insurance, they would pay a 10-year premium. After that, it's done, and the child keeps the benefit for the rest of their life. You can do a 20 pay, but usually it's about pay to 100. That's the most average. You pay your premiums until you're 100 years old, okay? Now let's switch to Indexed Universal Life. Indexed Universal Life is also a type of permanent life insurance, okay? If you pay the target premium, it lasts the rest of your life. It's paid to 100, just like any other whole life. Here's the cool thing, it's flexible. So you can actually pay less and pay a minimum premium. What it does then is that it's going to use a combination of your premiums and the cash value that it earns in the side cash account to make your premium last a certain period of time. Let's say if I started a policy right now at 30 years old, 100K, my policy is probably going to last 43 years at minimum. If I pay the target, I'm going to pay it till I'm 100, and I'll have that for life, okay? Fixed index means exactly what I said before. Floor rate, and cap rate. Forrester's SUL is a type of index universal life, but it's their own version of it. Other carriers like Mutual of Omaha's IULE, F&G Patsetter, F&G Everlast, Transamerica Index Universal Life. Those are going to have a little bit wider ranges, okay? Usually you're going to have a 0% or maybe 1% floor, and then you're going to have a max percentage, okay? So that's pretty much the big difference. You're still going to earn cash value. You can earn a lot more cash value in an IUL than you would a traditional whole life. So pretty much with an IUL, you're going to use those for a couple different reasons, okay? Let's say you have a client that likes term, but they're asking you a question. Well, I'm paying for this for 30 years, and what happens after? Great question. The policy's over. You're done. Some carriers have a guaranteed insurability or a guaranteed convertibility clause, which allows you to convert it to whole life or convert it to, or continue the policy as a annual renewable term after the policy's done or within the policy parameters. But you know, that's not the most financially responsible way to do it, because you're paying all that money into those years and then it's gone. It's just like paying your car insurance, right? You're paying that money to do its job. You show them a universal life product, right? They can still get that death benefit and they can have cash value. So let's say 30 years from now, I pay probably $100 more a month for an SUL than I would a term. I'm going to be able to get pretty much all my money back, if not more, at the end of 30 years because of the way the cash value grows. So clients will see that, well, hey, now I'll pay all this money in 30 years. If I don't want the insurance anymore, I'll just cash it out and be done with it, right? At least I'll be able to get that money back. Now, one of the things you need to pay attention to, if people surrender their entire policy, their cash value, the policy's over, it ends. The cash value is needed to continue the account, okay? So if you take out that cash value and you just bring that amount to zero, that's it. You're going to pay taxes on that cash value because you earned interest, that deferred taxes, okay? Interest, earning interest is always tax. So if they surrender that amount, that now becomes taxable. Whatever you earned interest on is going to become taxable. An index universal life policy allows you to have a set cost of insurance. So let's say my annual premium for $100,000 universal life, the cost of insurance is $1,000. I can overfund that and put more money into it to allow cash value to grow bigger. So what the carrier is going to do is that this is your cost of insurance, right? $1,000 a year, and I'm putting an extra $2,000 in there. What that $2,000 is going to do is going to go into that side account, okay? This is going to stay the same the entire time until I'm 100, and it's just going to do its job by keeping the death benefit the same, okay? My cash value is just going to go, my extra amount, the premium over the cost of insurance, is just going to go into the side cash account to earn cash value. So you can fund those pretty much as you want, but there are tax laws. The biggest one is a policy becoming a modified endowment contract, or we call it a MEC, M-E-C, MEC. What the law says is that if your premiums that you pay up for the cost of insurance end up being more than what you would pay over 7 years, it automatically becomes a MEC, which is non-desirable. You do never want that to happen. As soon as your policy becomes a MEC, you're heavily, 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 heavily taxed on all that money in there. So you've got to keep that premium and overfunding within a certain amount. So usually when you're running these illustrations, you're going to show max accumulation or max income. That's going to allow you to show the client how much they can put in without it creating a MEC, okay? So the first way is, like we said before, someone who's worried about a death benefit, right? Or worried about spending all that money on term without any return to themselves, okay? That would say, let's say I have a $100,000 mortgage, and in 30 years, I want to take that money out, right? That would be a good way to have a level universal life. So that means the death benefit stays the same and the premium stays the same for age to 100. But I know at 30 years, through the illustration that I've shown them, that at 30 years, the amount that I put in is equal to or more, depending on the situation, maybe less if they're older, but it sometimes more, that I can take that cash value, surrender the policy, and just pay taxes on the interest earned. So now I know I'm getting a return on my investment. It's kind of like return of premium, but it's not exactly return of premium. I would say the big difference there is with return of premium, you are paying for insurance for a certain term. At the end of that term, you get all of your premiums back. Okay. Here's the thing, you don't have access to that money at all in a return of premium policy. Zero. You have to wait the entire term. If you cancel the policy, boom, it's gone. All that money's gone. Okay. With an index universal life, you can use that money all along the way. Now, there's certain rules per carrier on what you can do, but that's pretty much the basics. So if going back to someone who's worried about a death benefit, that's a great way to show them extra value, right? Chad does this quite a bit, especially for young people. If you're showing them an SUL, excuse me, if you're showing them SUL, it's pretty darn cheap, but now they've taken care of insurance for the rest of their life. They don't have to worry about it anymore. They can make changes to it as long as they're healthy, wherever they are in their life. Okay. So that's great. But now, what's the other way you can use an IUL? You can use an IUL to create a tax-free retirement. That's right, tax-free retirement. That's the other way you can use an index universal life. Now, what you're doing in that situation is that you're trying to pump that policy with as much cash value as possible in your lifetime to about a certain age, usually retirement age. And then what you're going to do is take some systematic loans out every year for a certain number of years. Typically, we're going to see 20 to 25 years. So if I retire at 65, I want to take a loan out every year for my policy for 20 years while never reaching zero in that cash value. What that allows you to do is a loan is never taxed, ever. So with loans not being taxed, you're essentially taking income from this policy every single year without having to pay taxes on it, right? You don't have to claim it on your income. All right. So the other thing is you can't claim it on your income, you know, if you're trying to buy a car or a house. So there are drawbacks, but I mean, who's going to shake a stick and an extra 20, 30, 50, $40,000 a year? And that brings me to the $1 million baby. If you can set up a IUL for a child, right? When they're young, the parent can pay for it. Let's say it's $100. They put $100 a month into this account for their 8-year-old son. Okay. They put it in every month. By the time they're 18, they'll have enough money in cash value to pull it out and help them pay for college. By the time that they reach 30, they'll have enough money to pull out and put money down on a house. By the time they're 65, they'll have enough money in there about, I mean, I did one the other day about $1.6 million in total account money, cash value account. Okay. The younger you start, the more money you're going to have in the end. So that's a great way to add value to clients, especially if they have children, right? How do you get paid on an index universal life? You're going to get paid on the target premium only. Well, not only. You're going to get paid on the target premium and then a small percentage of the overage, okay? But it's a great way to add extra AP to your monthly goal, and it's a great way to build value with your clients, right? There's a couple of other different things that you can do. You can front load IUL. What I mean by front loading is if I have an extra $10,000 and I want to put it into the account so it earns cash value immediately, I can do that. So let's see. Pretty much the people you're going to work with, the carriers for the IUL, if you're looking for cash value, retirement, or returns, you're really going to want to look at F&G, Fidelity and Guarantee, Path Setter. That is going to be the maximum program. They're going to have the better interest rates. You have more control of where your money goes into which accounts. MU IULE So Mutual of Omaha has a program called IULE. That's a great way to do it as well, which is pretty neat. They'll do that. They'll give you a little bit more control. You're not going to earn as much. They don't have accounts like F&G that are going to earn much higher. You can do that with Moo, but I would recommend, just if you're looking for max accumulation and income, just use F&G Pathsetter. Moo IULE and Forrester's SUL are mainly for people who are worried about keeping the death benefit for the rest of their life, or permanent insurance, and having the cash value as a secondary bonus, right? Whereas using an F&G Pathsetter, the death benefit's just kind of there as a bonus, but they're really looking for that cash value. A lot of rich people will do what's called infinite banking, and they'll create a large IUL, and they'll be able to pull out money and pay it back to themselves interest-free, right? They'll just keep on doing that, keep allowing it to grow. A lot of people have those accounts because you can't lose. Since there's a floor percentage rate, if the market tanks and goes to -30 like it did in 2008, your policy at worst is going to earn 0%. So your money doesn't change, right? If the market does plus 30%, right, when it rebounds, you're going to earn a maximum of 13.5% in most cases. Okay, so it's going to stay pretty consistent over time. And I'll show you when I do an illustration what it ends up looking like and where to put that money. So let's go ahead and hop into that. Actually, before I start this, does anyone have any questions so far? Open up the floor.
Lake, it's Debbie. I just want to say one thing. Last year, I did the Mutual of Omaha IUL for my son, who's 32, and he's now started telling all his friends about it. And I just feel really great about the whole idea.
Yeah, it's a great way to get the younger crowd to start taking insurance seriously, for sure. Colby, I saw your hand go up.
Yeah, I wanted to get a follow-up on the $1 million baby. You were saying that if you put it in early, starting it that way, but you were mentioning pulling out money annually, you have to pull out a certain percentage annually. How does that work?
Yeah, so with $1 million baby, you can set it up 1,000 different ways. Okay. For the first 15 years of the policy, you're going to have what's called a loan interest rate. Sometimes carriers will do 10 years. I've got to look at the specifics. Each carrier is a little bit different. But let's say if you're going to take out a loan and you wanted to pay it back, you're going to have to pay interest on that to the carrier, usually about 4 to 6%, which is still less than a personal loan. But you're not taking out a loan and paying it back, right? You're just taking out the money and continuing to put in your premium. So let's say I'm putting in I just have a baby. I'm putting in $100 a month every month for that baby. When they turn 18, I'll be able to take out a certain amount of money and put that towards their college. Then by the time they're 30, I can take out that certain amount of money towards their first down payment. And then without repaying those back, by the time they're 65, they'll still have plenty in retirement, at which point the policy will be paid up, because we're going to set it up to be paid from their age is 0 to age 65. The policy is going to be completely paid up. So the cost of insurance goes away after 65. They're going to draw on their cash value from ages 65 to whatever length of time you want it to last, usually 20 to 25 years. Does that make sense, Colby?
Yeah, I think I caught that. So they don't have to necessarily take out, to make sure I understand, they don't have to take it out every year.
They don't have to.
You're just encouraging them. That's a good way to do it. And then you don't have to pay it back. Just keep paying your premiums. Benefit you at different times of life. I think
exactly. Exactly. So if you don't take any of it out, your policy's going to do pretty much the same as what it's going to do anyways. Because when you take money out of a universal life, this is where it gets a little wacky. You're not taking money from the cash value per se, you're taking money from the account value. So it pretty much stays the same, and you still compound interest on that loan amount. That's kind of where we're going to go into advanced IULs. I don't really want to get into that tonight. And to be honest, I'm not a 100% expert on that. That would be a Jared Leifert question. Chad, what's up?
Hey, so I recently wrote an IUL for a 42-year-old guy who he's looking to retire, I don't know, probably about 60, 65. And I actually set it up. I used the path setter to where he's going to be drawing $1,000 a month until he's age 100. So he wanted a month, just a little bit of residual monthly income. He loved it. It was easy. And I recommend it, man. It was pretty cool. So
yeah, it's great. I showed my my stepbrother what it would look like for him. He's 18, right? He just turned 18. So you know, getting him to spend $250 a month, that was a lot of money to all of us at 18. But you know, if he did that every month in, month out until he was 65, he'd have 197,000 he could pull out each year until he was age 85, which is pretty cool. All right, so let me kind of break down and show you guys a basic illustration. First, we're going to start off with the easy one, which is Forster's SUL. You guys are going to probably be familiar with it. And then we're going to go right into F and G and play around with the more advanced IUL. All right. So this is Forster's Financial's quoting program called Foresight. You can find it right in your Forster's Financial login. Talk to your upline if you don't know where it is. Make sure you select your state that you're in. I'm all the way up in Maine where it's negative 14 degrees right now. Smart UL 2021. So Forster's has their version of a universal life. You're going to earn less percentage just right off the bat, right? But your floor rate is 2%. So no matter what the market does, you're still earning 2% on your money. Their cap rate is pretty low. It's usually like 8%, I think, somewhere in there. Aaron's telling me he's seen it as high as 6.2. Right now, the average is about 4.5 is what the new percentage rate is. So this is assuming that this is going to be the rate for the rest of this client's life until age 100. So let's say we've got a client who's 35 years old. He's non-tobacco. And he wants a $400,000 policy, right? He owes about $400,000 on his house. So it's pretty easy. You run this program and it's going to show me. Can you guys see that down there? Specified premium. So if he wanted a $400,000 universal life policy, he'd have to pay $296.96 a month for that. If he paid the minimum, it'd be $173 and change per month. Now check out this quick illustration. If you go over here and add a glance, it'll show you the cash value earned, okay? So modal premium is the same as target premium, 296, pretty much the same. So we got the premium outlay. So that's the cost of insurance year in, year out, the cumulative. So adding year on top of year on top of year, that's the total cost of insurance. Check this out. This is his cash value line. Look at year, let's see, at year 16, this policy, the account value matches the cash value. So this is the amount he can take out at any time. In 15 years, he's going to have paid in $57,000 in insurance, but he'll have access to $46,000 in cash value. But he has a 30-year loan. Let's check it out. In 30 years, he'll have paid $100,000 into this account at age 65, but he doesn't need this insurance anymore. He can take out $126,000. He'll actually have made $20,000 while protecting his family for 30 years. Can you see how huge that value is? One thing I want to keep clear, though, universal life is not for everybody. Do not show this to every single person. You need to listen to their needs. Sometimes people just want the insurance to do their job, and pay off the home if they pass away or get disabled, because that is the least expensive option. Okay. In this sense, this guy's young, he's healthy. He's going to be able to pull out an extra $20,000 over what he paid, or he can continue to pay the policy. At about age 90, you're going to see this policy start to drop off. Okay, so the maximum cash value he's going to have, excuse me, is $294,000 at 91. That's the maximum cash value he's going to get. He'll have made almost $100,000 on his money if he's still alive at that point, that he can take out and surrender. But what happens is after age 91, it gets really very, very expensive to insure somebody. Very expensive. So they're going to start to use your cash value for the last 9 years to help with what you're paying to keep up with the cost of insurance. Okay. At age 100, if he survives that long, the policy's paid up and you'll have $400,000 for the rest of his life. Okay. Very straightforward. So this is a great way to talk to people about that extra value. Sometimes if you get people who want to think about it, you know, they don't want to think about putting that money towards something that's not gonna have a huge return, right? So you show them an SUL and say, hey, listen, 10 years down the road, you have a boiler that breaks, your water boiler, your water heater, it breaks. It's about $2,000 just to get a new one, and it's going to cost about $1,000 to $1,000 in labor, right? So that's $3,000 you could spend in total. Well, look, 10 years from now, you're going to have $18,000 in cash value. Why would you go for a personal loan if you need that? You don't have $3,000. You're going to pay 9-10% on a personal loan, or you could take out a loan from your own policy at a smaller percentage rate, usually between 4 and 6% with Foresters. Okay. Their heads start turning. Wow. So this is like my money. Yeah, it's your money. Guess what? After 10 or 15 years, you're not going to have to pay that percentage rate back. It's basically an interest-free loan at that point. So they get access to that money all along the way. This is another way to bridge the gap for people who are looking for disability, right? People who are looking for strict disability. They're like, I don't care about the death benefit that much. You know, I'm looking for the disability. I'm a single person, right? You're going to show them an SUL. Why? Because it has a living benefits. So if they needed to, if they had a heart attack, stroke, or cancer, or they become permanently disabled, they have access to that death benefit still, up to 95% of that death benefit. But let's say he's out of work for 6 weeks, 15 years from now, right? He's out of work for 6 weeks because he broke his arm. He doesn't have disability through work. Hey, check it out. Why don't you take some money? You make about $3,000 a month. Why don't you take $12,000 out of your universal life policy and just pay yourself back over time, right? Or you don't have to pay it back, right? So you just have to explain that to people, the options that are available to them, okay? So this is a simplified version of a universal life policy for people who are mainly focused on the benefits of death benefit or disability and cash value, right? They're not really interested in investing their money to watch it grow and use it as income. This is more of a backup kind of death benefit savings plan. Is that making sense to you guys? Okay. So another cool thing that you can do with the SUL and IULE, let's go back to the client. Let's change him to about almost 70 years old. Okay. Whoops. 52, January 2. So he's 70 years old, right? He's not going to be able to get the full 400,000. After age 55, you're going to be able to get 150,000. Right? This is for someone who's worried about the death benefit, not the cash value. Look, so the target premium is a lot of money. It's about $100 less for the minimum premium. Chad, can you do me a favor?
Sure, what's up?
All right, so look at this. The guy has a 20-year loan. and he's 70 years old. What does that mean? He usually can only get a 10-year term, maybe 15-year term policy. Let's say he just wants to pay the minimum premium. So now he's paying just the minimum premium. Let's go see what that illustration looks like. Boom. He's got a 20-year term. It's going to last 20 years for him now. Now let's go back and check out what a term would cost. So, Chad, did you see the minimum premium? 150.
555. Yep.
Yep. Can you remember that number for me?
Sure.
Now let's see. All right. So with a term product, issue age cannot exceed 65. Let's see if 15 years is going to work. Nope. Oh, it works. How much is that going to be? 618 for 150,000? What? What is that? Right? Boom. That's an extra way to save your client $60 a month by using the minimum premium when they're older in order to squeeze out some of that extra term, because that's what a universal life can do. It can just act like term insurance if you wanted to pay the minimum premium. Now, let's say if he wanted to extend that, he has a 30-year loan, right? Obviously, this is a fictitious, that's still a lot of money a month, but you have clients out there that'll pay that for sure. Let's say we're paying the minimum premium. It was $555. It would last 20 years. If I scroll down here and I specify amount, what was the amount? What was the minimum premium?
555.71.
So let's put in an extra $44 and change a month. Let's see what that rolls out to. That gives them an extra 3 years, right? An extra 3 years. Let's see what an extra $100 a month does. Boom, 28 years, right? It gives them 28 years. So you can design it between the minimum and the target premium of what you want to do, right? Obviously, if you hit the target premium, it's going to last the rest of his life, okay? Now, real quick before we go, how to read an illustration to a client. That is pretty much what I use when it comes to an SUL or IULE. I'm just going to use the cash value illustration right from here. And then I'm going to go and show them the actual illustration, because legally, I mean, you don't have to show them an illustration, but it's a lot easier. So this is a PDF that I would send a client. Let me blow this up a little bit. Okay. All right. So age 70, 150,000. If he dies in a common carrier accident, it still doubles. Even at his age, it expires at age 85. Right here, minimum premium is $555.71, what we talked about. If he wanted to make a one-time payment, he would pay $95,000 and trade for a paid-up policy of $150,000. The level premium is $9,000 per year, and the 7-pay premium, that means he cannot pay more than $17,308 every year, or it'll become a modified endowment contract. Remember, we talked about that earlier. So that's the max he can fund this policy before it becomes a MEC. So usually you're going to go in here and you're going to explain to clients preferred loans after 7th year. That's pretty cool. Preferred loan rates. It's still going to come with living benefits. This is a narrative summary for what they would do for their death benefit. Their death benefit obviously goes up and stays level for the entire time until they hit 91. If they're paying the same premium, it's not going to change. Their premium is always going to go up, and their cash value is going to go up and down, just like we said, right at 90, 91, right? This is non-guaranteed assumptions, which means the percentage rate. This is guaranteed assumptions. Let me explain that really quick. Guaranteed assumptions due to legals, due to laws, you have to show a client what the guaranteed assumption would be. So this is showing their policy at guaranteed 2%, because they're guaranteed the minimum if the market crashes, right? They're guaranteed that. The non-guaranteed is the current interest rate That's not technically guaranteed because it can change year to year, right? Right now, we use the average of the last 10, 20 years. They're using the average interest rate to show the client what it would look like, right? What are the chances the market's going to stay down for the next 20, 30 years while they have this policy? Below zero. It's not likely. Even in 2008, we went through 2008, the market rebounded a few years after. The S&P 500 is averaging like 7.84% in the last 20 years, okay? So the likelihood of that happening is not zero, but pretty close to it. So this is the guaranteed assumptions, which is what you're going to show them. Usually I just skip down to here to show them the loan amount. If I can find it. Let's see. Let's see. Okay. Can't find it there, but this is the illustration that shows both the guaranteed assumptions at 2% and the current initial interest rate of 4.5%. So this is the illustration that you would show them. If you're in person, you'd have them sign it. Forrester's e-app is pretty easy when it comes to that. Okay, so perfect. 6%. I don't see the loan rate on here. I don't want to spend too much time on it. Yeah, it's somewhere. For the first 15 years, all policies are going to have a surrender charge. So if they decide to surrender the entire amount of their policy in year 12, that's what they would pay in this particular case. Okay, so make sure you're mentioning that if someone has a 15-year term, just wait one more year before they pull that money out so that they don't pay any surrender charges, right? If they have a 10-year term, you're going to take this amount and just subtract it from, you know, whatever they're earning in year 10. So year 10, they'll have 40,000 in cash value. The surrender charge to pull all of that out would be $3,300. Okay. I know this is a lot to absorb. I'm recording this, so don't worry about it. There's a lot in here. But there's a lot of great information on carriers' websites. If you want to go and do their training, there's additional training on Workplace as well. So that's Forrester's SUL for someone who is looking for a permanent life insurance, and typically it's cheaper than whole life insurance. So now let's get into the big dog, F&G. Let's do $1 million baby scenario. Life insurance. Oops. That's my writing number. If you guys want to use it when you're writing policies, that's fine. All right, let's say we've got a New Year's baby. He's a male. Make him female, cost of insurance is a little less. Let's say, Chad, how much money does this family have a month to put towards their child's future?
About extra money a month?
Yep.
Let's just say $150 a month.
150. Okay. 50 premium. All right. So let's select the states. Maine, Indexed Universal Life. F&G Path Setter. Don't ask me about the other ones. I don't know much about them. Right. This is where it gets a little funky, so I'm going to go real slow. The owner of the policy is going to be the parents because they're not old enough to get insurance, right? You can own insurance policy at the age of 18. They're not 18, so their parents are going to own that. By the way, guys, that's extra value. because they have access to the cash value at any point in time, right? So their parents can pull that cash out. It's not just the child. Even if they kept it until their age 50, right? Because their child is not responsible enough to keep paying $150 a month. The parents have access to the cash value. So Chad is the new baby daddy. All right, so we want to solve for max accumulation and income. This is going to pop up. So when do we want the kid to retire, right? We're going to go with the national average. We're actually going to solve it for the face because we want to see which face amount is going to populate. Okay, come on. Get to that in just a second. So the kid is obviously pretty newborn. So year 65, why 65? See this, hover over this real quick. To indicate age, type A. To indicate policy year is Y. Okay, so pay premiums to year 65. Get out of here. Now, at age 65, actually at year 100, we always want to keep the cash value to 1,000 so that this policy never runs out. Okay, just keep that in mind, right? Now we want to see income type, loan, monthly income mode, starting at age 65, and for how long you want that loan to last. Let's say 20 years. I mean, if we're being realistic, this child's going to have Social Security. So if they outlive past age 85, mostly everything will be paid off, hopefully, or whatever. But that's a good chunk of change. 20 years, living past age 85 is a pretty good rate. Now we want to see how much we want to put in. So let's change that to monthly. We want to put in, what did you say, Chad? $150 a month? So that's $150 a month. I'm going to save that. So that's $1,800 a year. And okay. So now with a universal life, what are you trying to do? You're trying to grow as much cash value as possible, right? But hey, it's going to cost you some money because the cost of insurance, right? So you want to keep the cost of insurance as low as possible. So you want the face amount, the initial face amount, to be as low as possible. As low as it can go with F&G is $50,000. Okay, it can grow pretty much unlimited after that. Now, Lake, with a level face amount, they're going to reach a MEC at a certain amount of time. It's not going to allow cash value to grow. Here's the cool thing. You can actually switch it. So varies option B to A. We're changing that in year 65, which means option B allows the death benefit to increase. It's going to cost a little bit more money in insurance, but what happens if your ceiling keeps going? Your cash value can keep growing with it. If your ceiling keeps getting higher and higher, your ceiling grows with it. So you can put more cash value in there. So age 65. All right. We don't need to worry about premium. Now, interest crediting options. These are all the options that the parents are going to have access to. S&P annual point to point. What's point to point mean? Point to point pretty much means that, let's say last year the market did 30%. You're going to get 100% of the participation rate. So let's say the cap is 13%. You're going to earn 13% on your next year. Okay, so it's a look back. They're looking back at what last year did. They're going to credit it you for the next year. Make sense? Okay, so the illustrated average rate is 7.47. That's the average over the last 20 years the S&P has done. S&P point to point with a 1% bonus means that whatever you're earning, you're going to earn 100% the current rate plus 1%. So if last year's rate was 8%, you're going to get 9% for the next year. Okay. 140% participation means that if last year's rate was 10%, what's 140% of 10? Right? Why am I so slow? I bet Josh Harris is going to watch this and laugh his butt off at me. because I can't do math that quick. It's 14. Yeah, it's 14. Duh, take away the 0. Come on, it's almost 9 o'clock. So that means that let's say it's at 10%, you're going to earn 14% because you're earning 104%, 140% participation. S&P monthly point to point means that they're going to look back how the interest changes every month, right? Barclays Trailblazer is 145% plus a 1% bonus. So what I like to do and what I was taught is you put half the money in Barclays and half the money in the S&P annual point to point. Why? Because they have the highest rates out of both of them. Now you can do this however you want, whichever the client feels like they want to do. They can split it up as long as it reaches a total 100% combined. Make sense? Okay. So now that we have that, let's view and print an illustration. While we're waiting, can you guys see my Kraken back there? My awesome wife got me that old-timey painting of a Kraken taking down a clipper ship. It's pretty cool.
I like it. I like it.
All right, here is, let's see if I did this
Nice.
illustration right. All right, let me go back here. This keeps doing it to me, so hang tight.
Nice haircut.
Thank you.
You're welcome.
Gonna meet a billionaire this weekend, so gotta look sharp. Okay, so what it's doing is the initial face amount is going to be $304,000. Okay, let's see if this came out right. Something's doesn't feel right about this. Oh, okay, perfect. All right, so the parents are putting $1,800 in a year. Okay, this is the guaranteed assumptions at 0.25%, right? That's a guaranteed. Most likely not going to happen. This is if you chose the fixed interest rate, which means no matter what, you're going to earn 4.75%. No matter what the market does, you're going to earn. And this is the current rate split between the two rates that we chose. Okay. So this is your death benefit. This is the initial death benefit. So if she passed away, parents would receive $306,000. Look at that amount grow. Now look at the cash value growing. By the time she's 25, she's already going to have $106,000 in there. Okay, here's where it gets really cool. So now the child is age 60, they'll have paid $108,000 in there. It's a lot of money, right? Plus another 5 years. So they'll have paid a total of $117,000 into this account. Oh my God, that's a lot of money. Oh, but wait, look how much money we turned that into with cash value. Whoops. We turned 117,000 into 6.1 million. So they paid the insurance until age 65. If they took a loan out year after year from their cash value from age 66 to age 85, they'll be able to pull out $308,000 in income every year for 20 years. $117,000 became 6.1 million. That is the $1 million baby. Pretty cool, right?
Mm-hmm.
All right.
That's
So
nuts.
let's hear some questions, guys. That pretty much concludes our IUL training. Get with your upline if you have more questions. Really, your target market's going to be people who are 30 to 55 if they're looking to personally retire. Obviously, you have $1 million babies. One thing I do want to show you, you get paid off the target premium. So the target premium is just the cost of insurance. So let me pull that up. Cost of insurance plus a little extra. All right. So you wrote an $1,800 AP policy, which counts towards your monthly AP. But what will you get paid on is your target. So target premium is $1,353. Whatever your contract level is, that's the amount you're going to get paid on. Okay. The parents can put in a max of $9,000, or excuse me, $5,000 a year into this policy. They can continue to put this money into. Okay. They're only putting 1,800. They can put a max of 5,300 a year. So that's it. A lot of information, lots and lots of information. So let's get some questions. It's 8:56. Like I said, we're probably going to go a little bit over, depending on how many questions we have. So fire away.
So Lake, I have a question.
Yes, who is this?
Melissa, sorry.
Melissa.
Yes. Hi. What is like the oldest age that you could do $1 million baby? Does it have to be when they're a baby? What's the cutoff?
No, so good point. The cost of insurance rises as you age. Okay. So that $100 at age 0 is not going to give you as much income as an 8-year-old. When I did an 8-year-old's, universal life policy, it was like 2 million, right? It's $4 million they lost in 8 years because they didn't start that.
Okay. So you can do it up until like age 18. It's just they're not going
Right.
to gain that much.
Right.
As much.
Well, here's the thing. I mean, you can still do when the kid's 18, the parents can still put a policy on them. The parents would be the owner and the payer, and the kid would be the proposed insured. The kid would sign at that point.
Does the kid have to continue paying after the age of 18, or can the parents continue?
The parents can continue paying as long as they can until they think they can trust the kid to pay that amount a month. But since they started so young, it's only $150 a month,
Yeah.
right? Compared to someone.
Go ahead. Sorry, go ahead.
No, go ahead.
No, I only asked because I have a family friend that had asked about an insurance policy for a 17-year-old. So,
yeah, get with me, and if their needs fits it, we'll check it out.
okay, thank you.
Hey, Lake,
Yes, Chad.
I did an IUL for a 17-year-old this year. It was like $94 $94 a month for her. So he just
Really?
rounded it up to 100. Yeah, we just rounded it up to 100. So
Nice.
Do you know what they ended up with at the end?
I want to say she had $400,000 or $500,000 in there by the time she was like 50 or something like that. So it was
Like every year that she could take out?
oh yeah.
Mhm.
It was pretty awesome.
Yeah, it's wonderful. Cool thing, forgot to mention, Retirement Miracle by Patrick Kelly. You can't see it, it's backwards, that's inconvenient. But this is a good book. I'm reading through this. You've got another book that I haven't read yet, but it's called The Tax-Free Retirement by Patrick Kelly as well. So if you can get through those books, they're going to help. Josh Harris and Jared Lyford and Jared Salatis, they post some videos sometimes of a gentleman who goes into detail on YouTube about him. I'll see what we could do to get those videos from them. He explains them in depth. Any other questions?
Thank you, Lake.
That
You're
was awesome.
welcome.
That was awesome. Thank you.
Yeah, we'll have
You
this
rock,
recorded
Lake.
so you guys can
Yeah.
watch it
Hey,
again.
Lake.
Hey, John Wick, what's up?
Yeah. Hey, so question, besides the foresters, who else has like guaranteed transfer from like a term policy into a final expense?
You mean like, well, I mean, they all do the same thing. It's just the amount of interest that you're going to earn. I could set up this same type of scenario I did with the $1 Million Baby with foresters, but you're not going to earn that much interest rate. It doesn't go that high. So they all do essentially the same thing. F&G specifically is no exam up to $1 million of face amount for people under age 45 or 55. Okay. No exam means they're still going to be pretty picky about what they ask, and they can still ask for an exam. Okay. So you're going to want to use that on healthy individuals. Foresters is pretty lenient on that stuff when you're just looking for a death benefit. That is standard non-med coverage. Same with the Universal Life Express. And Transamerica's, they have a index universal life policy, but we never use them because they require medical exams.
Gotcha. Okay. Appreciate you.
Colby.
I think Suzanne might have been ahead of me.
Oh, Suzanne. What's up?
That's fine. He could have went, but my question is can somebody with a whole life policy, can they transfer it over to a UL?
Hey, love that. Excellent question. I didn't even reach that part of tonight. Yes, it's called a 1035 exchange. So they can take a cash value amount that they have in another account and they can transfer it to this policy. So it's like front loading the policy with your own cash, but it's from another policy. Great question.
That's what I thought. The people I talked to last night or yesterday, we talked about something like that. So they're supposed to be getting back with me with their policy information. But okay, thank you.
Awesome. Yes, great job.
So my question, Blake, was you said F&G actually has up to $1 million non-med?
Yes. It's not specifically non-med though. It's no exam.
No exam.
So that means it's kind of a fancy way of that saying if we feel like we want to give them an exam, we will.
Okay, that's why he said make sure they're healthy, like they don't have anything.
Yeah, make sure they're healthy. Yeah,
Okay.
make sure they're healthy. They're sort of lenient, but if you've got anybody with any serious issues that's questionable, it's really not for them. Unless they're specifically going for it, just reach out to your upline for advice on that. Aaron would tell you, hey, this is pretty much not a good idea. We can switch them to an SUL where they're going to be a little bit more lenient on stuff, especially with like diabetes, right? They're going to want blood work, things like that. And they're going to be a lot more in depth. Sometimes they'll ask for medical records. So typically with a non-medical insurance, they're going to check your MIB, your Medical Information Bureau, which is going to have all of your information from previously applied for medical and life insurance policies. If you've never tried one, you're not going to have any information on there. Then they're going to check your prescription history. Okay, they have access to your prescriptions. Then they're going to check your driver's license and your background that way. Okay, with this, they can ask for medical records. So they can actually have you call up your doctor, sign a waiver, a HIPAA waiver, and have your medical records sent to the carrier. It might help you avoid an exam, but it gets a little more complicated. So for all you guys new to IULs, I can't stress this enough. Please talk to your upline before you make any decisions on doing this. You can really mess up a client's investment opportunity if you don't do it correctly. So your upline is going to be more than happy to help you create the right way to do this. Another cool thing, if your upline isn't available, call F&G up. They're amazing. They have amazing customer service. Tell them what your client wants. Tell them what's the best way to give them the most money. They want this much premium per month. Do a risk assessment with them. They'll help you create it right at the sales desk and email you an illustration so that you know without a doubt that you did the best job for your client. Melissa, do you have another question?
Yeah, I do. So you had said the 1035 exchange, can you take out of like 401ks and put that into an IUL? Is that
Yeah, you can do that. Yeah, you can
or is
do
that more of an
So,
annuity?
well, an annuity is a whole different ball game.
Yeah.
Kind of. It's like a IUL with no death benefits, no non-taxable death benefit. Let's put it that way. You put money into an annuity, that's money typically that hasn't been taxed yet. And so when you die, there is a death benefit, but your beneficiaries would have to pay taxes on that amount because it was just all money that avoided taxes this whole time, right? They would have to pay taxes on the initial amount and the amount that was earned. So, and typically you're going to take money from old 401ks, not stuff that's current, because you can't really take money, you can't surrender a policy, depending on what type of investment you have for a 401k. You can't just say one day that I want to take all my money out of my 401k and put it in here, because there's some pretty hefty tax laws before age 59 and a half, or if you're terminated or leave your job.
All right, thank you.
Good question. 9:05, guys. Any other questions? This is not something we do very often. This is the first IUL training that I've done. It's not something we're going to do quite often. So get your questions out now if you have any. Time to do it. Going once, going twice. I would say we're going to call it a night. So guys, thank you for coming to this Wednesday Winners. I hope you guys have a great night. Continue to crush your week. Get some IULs sold, talk to your upline, talk to friends and family who want some life insurance or maybe want some additional retirement. There's some cool ways to do that. So yeah, we'll see you next week. Bye, guys.
Thank you.
Thanks, Blake.
Got it.
Thank you. Good night.